As an Indian investor, I promise you this is the only podcast that you need to watch today.
There's too much of chatter on the internet. Put all your money in Flexi cap funds and let the fund manager decide which market cap to invest in. And I can tell you it's a wrong argument. Investors who can manage their behavior will be able to eat most sophisticated fund managers on the Wall Street for dinner, which is exactly why we feel that AI is not the space to be in today. On the large cap, I will bet Flexi caps, value style. On the mid cap, I will do a mid cap with momentum style. And in the small cap, I will do a small cap with growth style.
How do you think the rest of the year will play out?
Don't have too much of hopes from 2026.
Do you think more people think that they're aggressive investors than they actually are?
At every point in time, one or two schemes in your portfolio will not do well. And you should be happy with that.
Hi Kirtan, very happy to host you on the Power of Money podcast.
Likewise, thank you so much for hosting me.
So let's dive into it, Kirtan. We're talking about a 30 to 35-year-old investor, let's say has been investing for a few years and invests regularly. What are the first three things you would check in their portfolio to see if it's actually well built?
I think there are 2-3 things that you typically look at. First you look at is whether or not the portfolio that you've built is aligned to your risk profile or not. Why is this extremely important is because most retail investors and specifically the DIY ones, unfortunately they get carried away by the returns that schemes have made over the last 2-3 years or in the near term.
The past return bias.
It's the biggest mistake that they make in their investment journey, and I can write this down for you that 8 out of 10 investors who pick funds like this will see that the next 3 years the same schemes have not done well because they don't understand the cyclicality of investments, they don't understand styles of investment, they don't understand that there may be a market cap bias or a sectoral bias that has worked out in favor of those schemes. So I think the first thing that you want to understand is whether or not your risk profile is aligned to the portfolio that you've built. So you are aggressive, but you only have 3 years of investment horizon. Then investing in a small cap or a sectoral fund does not really make sense, even if the last 3 years have been very good or 5 years have been very good. And typically we've seen people make a lot of these mistakes. The second very important one is to see whether or not these investments are aligned to your goals, right? So let's say if you have a near-term goal coming up, which is in a year and a half, and if you don't have money in debt, then you are wrongly invested. Let's say if you have a goal coming up in 2-3 years, and if you don't have money in hybrid, you are wrongly invested.
Right.
The third thing, very importantly, is how many schemes do they really have? You invest in a mutual fund because there are 5,000 plus stocks in the market. You don't know which stocks are going to do well over the next 5-10 years. You need a professional to help you identify 40, 50, 60 stocks which will probably do well in the next 5-6 years, right? But if you add more and more schemes to your portfolios, each of those schemes will have 50-60 stocks that they will invest in. So with a 15-20 mutual fund basket or a portfolio, you've invariably bought the entire market. How are you solving the problem of picking 50-60 stocks from the 5,000 stocks? So adding new mutual fund scheme in the name of diversification is a big mistake that we look out for.
How can an everyday retail investor identify what is their risk profile?
They will not be able to unless they've invested earlier in their lives. And I'll tell you why. You just go onto Google and search risk profiler. You will get 100 links where you will click, he'll ask you 10 questions, and basis those 10 questions, they would give you some gamified answer saying whether you are aggressive or conservative or moderate. Right? And this is the industry practice. Everybody does that, including ourselves. But I have seen this in the last 18-19 years that I have been doing this, that while the risk profiler says you are aggressive and you have a long-term investment horizon and you put larger share of your investments in equity, but when a COVID comes, when the last 2 years of underperformance comes, or a 2008 or a 2013 or a 2018 comes, invariably the same investor who originally thought that he was extremely aggressive starts to panic. Problem is that unless you've not seen a down cycle, you don't really know your behavior. And this is the hard fact of life.
Do you think more people think that they're aggressive investors than they actually are?
100% I would like to believe. There are enough and more research reports around this that a scheme would have made 15% CAGR, but the investor in the scheme has made only 10%. The fact of the matter is because you've not lived through the entire cycle of the fund. So the fund has been around for 10 years and you invested on day one and you stayed invested till the last day of the math, right? You would have made, let's say, 14%, but you made only 10% because you exited thinking that the fund is not giving return. Then you again came back when the fund started performing. When you do that, you will never be able to make returns equivalent to the returns that the funds have made. So in the world of investing, your behavior will decide 80% of your returns. 20% is the sophistication. Investors who can manage their behavior will be able to eat most sophisticated fund managers on the Wall Street for dinner. The problem is that the investor community does not have the discipline to stay invested. Look at the last 2 years. People who entered investing in October of 24, if they looked at the last 3 years of return, which means October of 21 to October of 24, I'll be surprised if they've not seen a 14-16% CAGR in
Absolutely.
21 to 24 as an era. Now imagine if you look at that data point to enter the market in October 24. From October 24 till the date that we are recording, market return is 0. Small cap is minus. Now imagine if you've entered the market looking at a 14 to 16% CAGR in 3 years, expecting a 14-16% CAGR, and 2 years of staying invested, your CAGR is 0 or negative in some cases if you've not picked the right investment. How are you going to satisfy yourself saying that I am a long-term investor? Okay, let me continue and it will work in my favor in the future. Whereas that's the whole fact. If you stay invested in exactly the same schemes that you are invested in, probably in the next 3 years, your CAGR will come to 12%. So to answer your question, I think most people think or thought in October or 24 that I am an aggressive investor and I will stay put. But if today also, if they are not questioning their investment decision, right, then they are aggressive.
So that's a good rule of thumb to have for everyone watching this, that if in the last 18 months you've been able to keep your calm and stay invested, then maybe you can consider yourself like more on the aggressive side. But if this time has been, let's say, anxious for you or has made you uncertain, then perhaps you're not an aggressive investor.
Like say for example, do you know whether the AI story will survive in the next 3 years? I'm not saying AI is a bubble or it'll go down. The point that I'm trying to make is that at some point in time, the valuations will reach a point after which you will start questioning whether or not the same EPS growth will be sustainable or not. And from there, the markets will fall. So you are doing the same mistake of entering the AI story, looking at the past returns, and probably preparing for an underperformance in the future. If this is also a thought that is coming to you, you are not an aggressive investor. Right? That's the whole point I'm trying to make.
You spoke about goals, Kirtan. What kind of mutual funds are perfect for what tenure of goals? Like for a 1 year goal, what should people be looking at? For 5 years, for 10 years? If you can guide people with that.
I think again a very interesting question because a lot of people don't understand this, right? So let's say if your goals are less than a year, you might as well only want to stay in products which are like an arbitrage fund or a money market fund or an ultra short term fund kind of a category. Arbitrage is for people who are in a slightly higher tax bracket, like the 30% and above ones, right? Because when you invest in an arbitrage fund, you make that 6%, but you will get an equity taxation because of which your post-tax returns are much better than probably a fixed deposit or even a money market fund or a ultra short term fund. But people who are, let's say, in the 10% tax bracket or in no tax bracket, you might as well want to do a money market fund because you will end up paying actually almost a 0% tax or a 10% tax in those kind of funds because ultimately that will get added to your income. A very interesting perspective that a lot of people don't look at. So less than 1 year, you stay in this category of funds. Okay. Let's say if you have 1 to 3 year of investment horizon, right? That's when you start exploring, trying to do hybrids. So let's say if you have closer to 1 year, so 18 months odd, you probably might look at an equity savings fund, okay, or a conservative hybrid fund. You have closer to 3 year, you might look at a balance advantage or a multi-asset kind of fund. Only if you have more than 3 years of investment horizon is where you actually start looking at equity. So 3 years and slightly above is when you look at large caps. You can't say that I am 3 years and I am aggressive, so I'll put money in small cap. Wrong. I've studied the last 20-25 years of market cycle, and you will see that large cap cycle is 3.5 years, mid cap cycle is 5-6 years, small cap cycle is close to 8 years, which means that if you've invested in a small cap at the peak, right, it's an 8-year cycle for the price to come back. Of course, your fund might do well and you might outperform and go above earlier than 8 years, but at the index level, the cycle is 8 years. Okay. So you will have to give yourself a minimum 8 years because you don't know if you are investing at the peak. Right. So come in with a 8-year view in a small cap, 5-6 year view in a mid cap, and at least a 3-year view in a large cap. Now, when you are looking at a large cap, if you are an active fund manager, you are looking at the slight alpha over the index, then you play the large cap theme with flexi cap.
Okay.
Right? If you are more passive, I think in large caps you do the index. Is as simple as that. For mid caps, and that's the risk you are willing to take, right? Again, if you are passive, you do the simple mid cap. If you are active, you can do active mid cap funds, or you can do the multi cap space, because largely the beta or the standard deviation, which are the risk parameters, or even if you look at the risk adjusted return of multi cap funds in this space, is very close to mid cap. So it will give you the same risk return profile in the mid cap space. And in the small cap, there is nothing else that you can do but you stick to small cap funds.
Let's say someone has 12 to 15 mutual funds in their portfolio today. How should they go about cleaning it up? And what is the bigger worry when it comes to over diversification? Is it having too many mutual funds? Is it having too many in the same category?
So everything is a problem when you have 12, 15, 20 funds that you invest in. I think in my opinion, what you really want to do is understand that diversification while you are trying to build a mutual fund portfolio comes at largely 3 levels. The first level of diversification is at the AMC level, which means that you don't want all schemes to be of the same AMC, right? Or you don't want majority of your schemes to be of the same AMC.
Why is that?
Because let's say if there is an underperformance for whatever reason, right, then you are actually, your entire portfolio is going to get affected.
So you're saying if a fund is underperforming in a particular AMC, most likely a lot of other fund schemes will also underperform in that AMC.
More or less, yes, because that AMC will follow one style of investment and that style is not very favorable, right? Now, of course, this is theoretical. You cannot put this to every AMC, and you might have some AMCs where the fund managers within the AMC may follow different style. But of course,
this
because
is the general rule of
this is the general rule. You have diversification across AMC, one. Second, you have diversification across market caps, right? So instead of putting all your money into a particular style of or in a particular category of fund, you might want to diversify it across large caps also, mid caps also, and small caps also. There is too much of chatter on the internet saying that, you know, put all your money in flexi cap funds and let the fund manager decide which market cap to invest in. I've been tracking this market for donkey years, and I can tell you it's a wrong argument. Before 2018, okay, if you look at large cap category in the country in India, large cap, because there was no definition of what is large cap. What has happened since 2018 was SEBI came out with a categorization rule. They said that the top 100 companies in India by market cap are the ones that you will call large cap.
Right.
Then you froze the large cap fund managers saying, boss, I cannot go outside of these 100 stocks for 80% of my portfolio. And which is why you see a transition in the AMC business that is not not written in black and white, but any observant will tell you this, that the style of investment that propelled in the large cap business moved to flexi cap. Today, if you see out of the 40, 45, whatever number of schemes that are there in the flexi cap business, 40% of them have 65, 70% in large cap at every point in time. Every point in time, right? And the remaining 35% will keep moving between mid cap and small cap. There are very few instances where this 30-35% of small cap, mid cap would have become 50%. But there are many instances or majority instances where your large cap, which is 65-70%, would have become 80%.
Right.
If you are going to tell me that, put all your money in flexi cap and let the fund manager decide, I think you are making a big mistake. Right. So, which is why our first discussion was diversification at AMC level. The second is diversification at market cap level.
Yes.
And the third that you would want to do is diversify across styles. There are 3 large styles that the fund manager community in India operates at. One is value, another is growth, third is momentum. Right? So what is value? Value in simple language means that you are investing in a fund where the fund manager's thesis is that they want to buy stocks cheap.
Okay.
Or contra. So let's say if I give you 2 stocks, one stock is at 10 PE, another stock is at 20 PE, same sector. Then the value guy will say, I will buy the 10 PE stock because that's my thesis. Okay. Right? Growth is completely opposite. The growth guy will say that same sector, 10 PE, 20 PE, I'll buy the 20 PE because the market is giving this guy 20 PE because the earnings growth of this guy is going to be much higher than the earnings growth of this guy. So I will bet on this guy. Momentum says wherever the liquidity moves, I will move there.
Okay, what does that mean?
So let's say if the defense sector is where the liquidity is moving in, I will add money to defense sector. If people are selling IT, I will sell IT. So it is more...
So sort of following the index?
No, sort of following technicals of the market.
Okay.
And following where large money is moving in or coming out of. At the style level, there are 3 major styles.
I'll actually just interrupt you at this moment and think about, so of course, till now we've spoken about a portfolio reality check of this 30-35-year-old investor. But since you're very, generously sharing, how to sort of, look at picking funds, let's take an example where this 30-35-year-old is starting from scratch, does not have a portfolio yet, and let's build a portfolio for this person. So of course, you've mentioned 3 things, which is, diversification at an AMC level, market cap level, and style level. So let's construct this portfolio.
So let's say if I am that 35-year-old and I have 100 rupees with me, I am this pseudo-aggressive investor that we spoke of, and specifically I have at least 10 years of investment horizon. Here's what in my opinion you should do as a 35-year-old. Make sure that out of the 100 rupees that you have, 25-30 rupees is split between US equity and gold.
Okay.
Now, first let's try and understand what problem is this solving.
Okay.
So, if I have 25-30% in gold and US equity, then I am solving 2 problems. The first problem that I am trying to solve is the rupee depreciation problem. While everybody today is talking about rupee depreciation and gold and global investing, if you go back to 5 years, when I would be on a TV channel talking about it, I've been talking about it since then. So it is not my learning of the latest fall. I've always constructed a portfolio like this, and I've always had this belief that this is what makes sense. Rupee has been depreciating between 3 to 4% every year.
Right.
Right. Today we are talking about 4% because the last 2 year depreciation has been significant. Originally, 5 years back, I would say rupee has been depreciating at 3%. And I would stick to rupee depreciation at 3% because in my opinion, in the next 3 years, rupee will benefit and not depreciate significantly to average out on the bad performance of the last 2 years. So let's stick to rupee depreciation at 3%.
Okay.
What happens is when you invest in global equities or gold, in both cases, let's say in both cases you make 12%. Okay, but in India, rupee denomination, you end up making 15% because of 3% depreciation.
Right.
Which means, let's say if I have invested in S&P 500. Now, if S&P 500 delivers 12% return, I will technically in rupee make 15% because 12% is from the stock and 3% is from the rupee depreciation.
Okay.
Same is with gold. If you look at the gold returns over the last 25-30 years, and let's say gold has delivered 13% CAGR, 10% is actual gold return and 3% is rupee depreciation because gold globally trades in dollars. So first problem that this 25-30% portfolio solves is your 3% of rupee depreciation. The second problem that this 25-30% solves, let's take them independently now. First, the US equity is that there are themes that you don't get in India to play or invest in, which you will have to then hunt for somewhere outside. And in my opinion, US will 9 out of 10 times give you an opportunity to play the theme that is not available in India. You might not have to go to a Europe or a LATAM or a Brazil or a China for that, right? Point in case the last 2 years, the AI story. Right? India has not done well because India didn't have an AI story to offer, but had you invested in the US, you would have been able to play the story. So if I was in the US in the last 2 years, I would have made 30-35% returns, which I could not make in India. That's one problem that you are solving. Second, you look at all of these markets, the run-up has actually been extremely concentrated. 2 stocks generating 40% of the market cap at index level. Imagine if 2 stocks are 40% of the market cap, what are you really investing in? You are actually investing in only those 2 stocks, right? And thematic investing is not so easy.
Yeah.
Right? People would believe that AI as a story will be the future, and I completely believe that AI is going to be future. But if I take you to the .com bubble that happened in 2000, I think it's a very similar story. Every stock that said internet or .com went up. Right? But not everybody survived post that.
Right.
Whereas internet as a theme is still surviving.
Right.
They are watching us on the internet today. So the theme is correct, but you don't know who will be the end beneficiary of the theme, right?
Right.
Very similar story can play out. The only thing that you and I don't know is when. Because you cannot have companies growing profits at 400-500% like they are currently doing. It's not sustainable. At some point in time when the capex story pauses, right, all of these sub-themes of semis and electronics and data centers will all go for a toss. Already in 2026, out of the Magnificent 7, 3 are generating negative returns.
Absolutely. Out of the 100 rupees, 25 to 30 rupees should go to, the US market.
US markets and gold.
So that you can take advantage of the fact when Indian markets are not doing well and when rupee depreciates.
Perfect. Gold specifically also because we do this in investor portfolios. Look, gold in the long term will give you nifty kind of returns. So if I continue to hold gold in the longer term, I'm not losing out on anything. I'm still making equity kind of returns. But imagine a situation that 2008 has to happen again. 2013 has to happen again. 2018 has to happen again. 2020 has to happen again. You are a long-term aggressive investor. You are okay if your 100 rupees falls to 60 rupees. This is easy. But what if I tell you 10 crore portfolio falls down to 6 crore? Now, if you are aggressive, you know that I want to buy more of the markets today because at some point in time it is going to go up. But will you have the monies to average your portfolio today? 9 out of 10 times people will not have sizable money to average.
Correct.
Is exactly where gold plays out. What if I use the gold because at that point in time it would have not fallen much. It would have been stable or probably would have gone up. And I remove that and buy equities at 40% lower value. Then is when I create alpha. So that's the problem for me. US equities and gold ends up solving for the 25-30% of the portfolio.
Okay.
The remaining 70% of the portfolio has to focus on India domestic equity.
Okay.
Right? Because I very firmly believe you are earning in rupee. Most of the times you are spending in rupee. Yes, you can argue with me saying your iPhone is this or the camera that you use is this or you go abroad to travel, right. But that's 10, 12, 20% maximum of what I'm earning. Yeah. So utna paisa to I've invested in global markets, right? So 70% India domestic story. Okay. I don't see a reason why in the next 20 years we are still yet not the fastest growing economy in the country, and I think we are doing well. We will have a 10%, 12% nominal GDP. I don't see a reason why this portfolio will not do well. Okay, but in this 70%, you will split equally across large cap, mid cap, and small cap. If I split that equally across large, mid, small, my standard deviation, or what we call as risk, is slightly higher than large cap. But my return is mid cap or slightly higher than mid cap. Right? So I have been, with the diversification strategy, I've been able to build a portfolio which has large cap kind of risk but yet generates mid cap kind of returns. Right? So I would want to take advantage of large, mid, small, all three. Because if you ask me, Kirtan, which one will work out in the next 5 years? I don't know the answer. Suppose if I ask any investor, will small cap do well over 10 years or mid cap do well over 10 years? 9 out of 10 people will say small caps will do well, because that's how we are wired, that small cap will do much better than large cap, right? But look at the last 10 years, mid cap has done 3% better than the small cap. So you don't know what will do better in the future.
So might as well keep like equal allocation between large, mid and small cap.
Now you will take it a notch higher,
Okay.
right? Where I will introduce style diversification. Now how do we make sure that if you only want 4-5 schemes and the first level of diversification is at large, mid, small, how do we introduce styles? So what we do is very simple. In large, right, because we follow Flexi cap, like we invest in fund managers who follow value style in large cap, Flexi caps. Why? Now you might argue why value and why not growth or momentum in Flexi cap? The logic is pretty simple. In India, large cap companies are not like the large cap companies in the US, where their market cap from a 1 trillion is going to become 3 trillion. We don't spend on R&D, that's the hard fact, unfortunately. Okay, so you're not going to have.
So the growth is slower with large cap.
Growth is always going to be slower. Now imagine if you've bought large cap companies expensive, will you make money? The answer is no. Look at DMart, look at Kotak, look at HDFC, look at ITC, look at Asian Paints, 5-year return 0. If you are going to buy large cap stocks expensive, you are never going to be able to make money. So what our research shows us is that when you are trying to buy large cap, value style guys do much better than the other guys, right? Let me talk about small cap next. In small cap, you follow growth style strategy. Why? Because your thesis to invest in small cap is to be able to invest in multi-baggers. Now, you don't want a conservative guy here who's looking at value bets. You want somebody who
can take bold bets.
Who is looking at companies who are going to be able to grow at a much faster pace in the future. Because only then is when you will be able to make monies or be able to capture those multi-baggers. So you want to follow growth style in small caps. Okay. Now in mid caps, you want to go with fund managers who follow a little bit of momentum side of strategy, and I'll explain to you why. Exactly, again go back to 2018. After the categorization came in, first 100 stocks large cap, 101 to 250 mid cap, 250 and below small caps. Now you look at small caps, 250 and below, so many stocks. So if more money comes in, they can spread across multiple stocks. In the large cap, you have liquidity. So if more money is chasing him, you already have
100
liquid
stocks is enough. Right.
And liquid.
Right.
But more and more SIP is done in the mid and the small category. Now imagine a situation, more and more money is chasing the mid caps. But there are only 150 mid caps in the country.
Correct.
The fund managers have no other option but to look at these 150 stocks invariably, largely, to be able to deploy in the mid cap space. And which is why in the mid cap you will see that wherever there is more liquidity, those sectors are doing very well, or those stocks are doing very well. And which is why you've also seen that over the last 10 years, mid caps have done much better than small caps, because it's a concentrated bet. So we think that the momentum play will do very well in the mid cap space. So if I have 100 rupees to allocate, 25-30 will go to gold and US equity, 70 will get split across large, mid, small equally. On the large cap, I will bet flexi caps, value style. On the mid cap, I will do a mid cap or a multi cap with momentum style, and in the small cap I will do a small cap with growth style. That's how I will build a portfolio today.
Awesome. Now, two follow-up questions to that. A, how does an investor identify which style does the scheme follow, does the fund follow? And secondly, you also spoke about AMC diversification earlier. Do all AMCs follow one particular style of investing only? Like if Axis is following value, or if Parag Parikh is following value, will all schemes follow the same approach? How can investors know that?
Largely a yes. So let's say if Parag Parikh is following value, you will typically see most of their schemes are driven with the same approach, right? Yes, of course, you might have some fund managers within the scheme of things who may be growth style. That's okay. So let's say if there are two funds kept in front of me, and I have to tell you which one is following value and which is following growth, how will I be able to identify? Go to PE and PB of the portfolio, right? So PE ratio of the portfolio and price to book ratio of the portfolio of scheme A and scheme B, right? Whichever fund has a significantly lower PE PB are the funds who are following value style of investing, because they are trying to buy stocks cheap. And whichever funds have higher PE and PB are largely the ones who are doing growth style of investing, because they are okay to pay more to get a stock on board. That's the easiest way for you to be able to figure out who's value and who's growth.
Okay, got it. And momentum?
Momentum is slightly tricky. You will need to be able to talk to the fund manager, see their portfolio changes every month when the fact sheet comes out, for you to understand that these guys do more growth / momentum.
So we've spoken about this 35-year-old investor, and we have constructed a portfolio for this person. Even after applying all these filters, because your approach is that you don't need to have more than 4 or 5 schemes in your portfolio, how do you pick the right scheme?
Now this is again another level of sophistication that you will bring in, that you've understood that I want to do probably a flexi cap with value style, but there may be 10 flexi caps with a value style.
So how do you pick that one?
Now there are two ways to look at it. The first way is you look at quantitative parameters. I will look at probably a 3-year rolling return over a 10-year for a scheme to see if the scheme is consistent. I will look at the alpha of the scheme to try and understand, for the risk that the fund has taken, how much additional return have they generated. I will look at the Sortino ratio of the scheme to try and understand that for the downside risk that the fund protected, what advantage has the fund got on board. I will look at the standard deviation to try and understand that the risk of the scheme is what versus the other schemes. I look at the information ratio to try and understand that when markets are doing really well, is this scheme able to do well. I will look at something called as the up capture ratio and the down capture ratio of the scheme to try and understand that during the markets going up, is this scheme able to do better than the market, and when the markets are falling, is this scheme falling less than the market. I'll also help you how to look at this data. You want a higher rolling, right? So when you're comparing two schemes, you will pick the schemes that has higher rolling. When you're looking at Sortino, you will pick the scheme that has higher Sortino.
Right.
You will pick the scheme that has higher alpha, right? And you will pick the scheme which has lower down capture. That's what you do on the quant side.
Okay.
But I think the qualitative side is equally more important. How long the fund manager has been in the system, right? So if you are evaluating a scheme looking at the last 10 years of data point, but you've seen that the fund manager has changed in the last 3 years, all of the quantitative data points that you are looking at are worthless.
Right, because they belonged to the
7 years or the 10 year belong to somebody else.
Right.
You don't know whether this guy
can continue the same.
Second, how true to label is the fund?
Okay.
What do I mean when I say true to label? I was harping on a point while I was talking to you of large caps and flexi caps, saying that they are pseudo large caps.
Right.
I will not want to invest in a flexi cap which is a pseudo large cap. I would want a scheme to invest in which will actually take bets when the markets are going down and is changing the strategy. Markets are going up, they are changing the strategy, and they are acting as true flexi cap. Let's say if the fund manager tells you in the commentary that you know what, I'm very conscious of valuations in the market. Then is the fund manager standing cash when the markets look expensive? Because you want your fund manager to stand cash when on one side the fund manager is saying that it looks expensive to me, but on the other side is 100% deployed in the market. Now this does not go well.
Right.
I think these are 2-3 very important qualitative aspects that the investor has to look at while onboarding a fund or while getting out of the fund, because the aspect remains the same.
Should they all be actively managed funds? What is your take on index funding, index investing?
I think for large cap, index is brilliant, right? For mid cap, small cap, you will want to make a choice whether you go index or active.
But in mid and small, the chances of creating an alpha when you pick the right funds is much higher, right?
Which is why the whole reasoning of why you can look at active when you do mid and small, because the opportunity for the fund manager to be able to do alpha is much higher in mid and small versus in large. So large, I will not be surprised if you tell me that, you know what, I want to do index. Okay, please go ahead and do that. But in mid and small, you might want to look at actively managed funds because the opportunity of being able to generate alpha over a longer period of time is much higher, right? Now the problem with my strategy is I go active. The reason why I go active is because I cannot take an index bet on large cap, because then that is momentum in large cap. It's not value. Because how is index formed? Whatever stocks go up gets added to the index. Whatever stocks does not work gets removed out of the index. That's momentum strategy.
Right.
That's not value.
Correct.
And I am looking at a value style for so for me it does not work, but for people who are listening to me and they've understood my style, but they have their own style. So they should look at passive for large caps. But mid and small, they should look at actively managed funds, because I strongly believe that there is a case to generate significant alpha in mid and small space.
We've created this portfolio, but how should this person go about reviewing and rebalancing?
I think exactly the same thing that you looked at while you got the schemes on board.
Okay.
Is the fund manager still continuing? Is the fund manager true to the category? And he is true to what he is saying. So now you will say then, look, if he is doing what he was saying, then why is the scheme still underperforming? The scheme can underperform for multiple reasons. One of the reasons is style. Let's say in the last 2 years.
Like growth style,
correct. Growth would have not done well.
Correct.
Growth would have not done well in the last 2 years. Absolutely. Now you cannot go back to the fund manager and say, boss, you've not done well. I'm going to get out of your fund. It's your mistake, because you don't know that his style is growth. And the reason why you've added this is to bring diversification.
Correct.
Imagine you've built a portfolio where everything is doing well. Instead of you being happy, you should be sad because it's not diversified.
And also when
things will go south,
you
will lose everything.
Well.
Yes, exactly. I keep telling investors that we work with that at every point in time, 1 or 2 schemes in your portfolio will not do well. And you should be happy with that, because that's the whole objective of that being in the portfolio, is to be able to diversify. So you look at 10 years, your value will also do very well, momentum will also do very well, and growth will also do very well.
What would you say to this investor who's also tempted to explore many different categories? And also, is the portfolio that you recommended right now just the core portfolio?
So some people who understand how to do it can have a small satellite portfolio from that 70% that we had in domestic.
Right.
Can have 10-15% doing, let's say, sectoral investing and thematic investing, because they understand. But I'll tell you, the biggest problem with trying to do that is it's a double-edged sword. Right? Have you seen some fund manager coming to you and telling you, I can time the portfolio or I can time the market? No fund manager will come on record and tell you, I can time the market. They may be doing it, they may not be doing it, that's not the question.
But they won't claim it.
They won't claim that because when you claim you can time the market, it's a very risky thing to do. Why? Let's say I think markets are expensive today. I am standing on cash. I may be correct today, okay? But I will have to be again equally correct of when will I deploy this cash back in the market. So when you are trying to time the market, you have to be right twice. When you got out of the market to stand cash, and when you are deploying the money
Both
in the
entry
market.
and exit you have.
Both entry and exit. Most people can't even get one leg correct. And you are saying I will do 2 legs correct. Very difficult. Which is why a lot of people, when they do thematic investing, no, they probably might get the entry correct, but they don't know when to exit. And hence, they are not able to actually get the alpha that they are looking at doing thematic. Now, you might ask me a question, is there a solution?
Yes.
We take contra bets.
Okay.
Contra bets are the easiest, when I say easiest, relatively easiest way to do thematic investing, right? So, you invest not when there is momentum, but when there is no momentum. Let's say if defense is doing very well today, will I put money in defense? No. Let's say IT is not doing very well today, will I put money in IT? Yes. Because my probability of downside is much lower, because defense has already moved up so much.
Right.
If I get my timing wrong, the probability of me losing money in this sector is much higher. This sector is already available 50% lower. I'm not saying it will not fall more. It can much as well fall more. But the probability of me losing money here is going to be much lower. And my probability of making money here is going to be slightly higher than the probability making here. So you typically approach thematic investment as a contra bet or as a value bet. Don't end up taking bets in sectors that have done well. Take bet in sectors that have not done well.
Okay.
That's a much better and a easier way to do thematic.
Can you name a couple of sectors that are not doing well today?
IT, not doing well. Banking, not doing well. Today you have banking stocks available at a valuation that you saw them in 2020. Chemical, not doing well, right? I can give you a list, pharma. But the point that I'm trying to make is that that's the easier way for you to be able to do
take thematic bets.
Thematic bets than the other way around.
Got it.
Let's say for example, let's talk about gold and silver. Had you invested in gold and silver after it went up, silver is down 50%, gold is down 25%. It's not easy. But had you invested in gold and silver 3 years back when it was not moving, you would have made the rally. That's the whole point.
Understood.
Which is exactly why we feel that AI is not the space to be in today. And we are taking a contra AI bet in IT at 27,000 index level.
Any sectors that you are bullish on for the next few years?
Same.
The same sectors. What about auto?
Look, auto, in my opinion, a lot of these sectors are already a very large part of diversified portfolio. Great question, and let me try and explain this to you. Why do you take thematic bets? You take thematic bets because probably your core portfolio does not have them. Except for banking and financial services, all 3 sectors that I told you are not very large portfolio allocation in diversified portfolios today in MF. You will not see fund managers have very large allocation to pharma. You will not see fund managers have very large allocation to IT.
Fund managers have reduced allocation to IT.
You will not see fund managers have very large allocation to chemical. So you want to take exposure to sectors that your core portfolio does not have. That's the problem you are solving.
Right.
So my bet is not whether auto will do well or not. My bet is that amongst the sectors who are going to do well, where do I not have an exposure in my core portfolio that I am trying to solve with thematic?
Would anything change in the portfolio construction that we've just done for this 35-year-old investor? Would anything change if their risk profile changes?
Oh, 100%. If their risk profile is changing, then...
Can you quickly just tell me like how the allocation would change for, let's say, an aggressive investor, a balanced investor and a conservative investor?
So what we've done is for an aggressive investor. Okay. But let's say if a 35-year-old moderate investor comes to us, we will probably split this 70%
Indian equity exposure.
Indian equity into 35% India equity and 35% hybrid. So by that what I am doing is they have 35% core domestic portfolio. They have probably a 15% global portfolio. So they have 50% equity direct. They might have some equity through hybrid, but that hybrid will solve the debt portion and then they have gold, right? So that is what will happen if it's a moderate investor. And if it's a conservative investor, then we will not take a global portfolio in general. So they will have a 15% or a 20% to gold. They will have 60%, so 20 plus 60. This 60% is hybrids, fixed, aggressive hybrid, balance hybrid, conservative hybrid as a mix, and 20% as debt.
You just said that mostly debt separately just needs to be a part of a conservative investor's portfolio. But if someone just wants to have debt portion as an active part of their portfolio, where would you recommend?
So I would recommend them to do two things. First, if they are an aggressive investor, okay, whatever debt that they intend to invest in, they should split that debt into two categories: medium duration fund and credit risk fund. Because in India or globally, fixed income has cycles based on only two things. First is interest rates. If interest rate keeps moving up and down, this medium duration fund will keep moving up and down. And then there is credit. Okay? If the credit rating falls or credit rating goes up, the NAV will fluctuate.
Right.
You will take an advantage of both the cycles if you have diversification across both. But this is an aggressive allocation. You will need at least 4 or 5 years of investment horizon to be able to make the most of this allocation.
Okay.
So if you are an aggressive investor, split this like that. If you are a moderate, conservative kind of an investor, I would rather suggest you to stick with a money market fund and a short-term debt fund as a split as equals. I think that should solve your problem.
Today, what do you think is the ideal way to take exposure to gold? Is it, physical gold? Is it through mutual funds, ETFs? What is your recommendation?
I am a fanboy mutual fund in general. So my logic is very simple. You go ETF or you go mutual funds to go to gold. Why not a digital? Why not a physical? I think the answers are pretty straightforward and the world now knows it. If you want to go physical, there are 2-3 problems with physical. First, they are going to charge you a spread. What do I mean when I say spread? Today gold, let's say hypothetically, is available at 150,000, 1,50,000. So when you go to buy the gold, they will sell it to you at 155. And when you go to sell the gold, they'll buy it from you at 145. So there is a spread that you will lose out on. Most people don't buy gold as gold coins or gold bars, but as jewelry. You lose out on the making charges. Third, you pay 3% GST when you sell physical gold, right? Plus there is a purity problem and all of that. Why do you want to do all of that jig? So physical is gone. Digital has the same problem. Digital also has the same spread problem, and you pay 3% GST when you are buying gold digitally. So if you are buying 100 rupee worth of gold, you only get 97 rupee worth of gold. Why do that, right? All of these problems are solved when you buy gold using mutual funds, right? So you do gold ETF.
So mutual fund or ETF? Any particular one that you would recommend?
ETF will have a much lower cost. So
Right.
you do a gold ETF versus doing a gold mutual fund. That's an easier way to add on to gold.
So Kirtan, we've extensively spoken about how global exposure and especially investing in the US needs to be a part of an investor's portfolio. What is the best way to invest in the US market today?
See, for us, investing in the US market is plain simple NASDAQ ETF. But if you ask me today, where should you invest? Then my answer for today specifically is you should do S&P 500, then doing NASDAQ. Because like I said, that our view is that tech has really played out the story far more. Probably there may be some breaks that might have to be applied. There is upwards of $360 billion of IPOs coming up with SpaceX and Anthropic and all of these guys. There is going to be a lot of tech investment that is going to move from A to B. So so specifically, and it's not a core portfolio and it's more a thematic answer, today an S&P 500 makes more sense to us than doing a NASDAQ, but our core portfolio is NASDAQ.
How do you think 2026 has been so far? And what do you think, how do you think the rest of the year will play out?
See, I think don't have too much of hopes from 2026 because look, there are some controllables and then there are some uncontrollables. I think we are in a phase where we don't have the control of the situation, right? We are not able to control where the oil prices will move, and hence we are not able to control what deficit will we have in the country, and hence we are not able to control the rupee. One. Neither are we able to control the other side of it, where we don't have an AI story and the world is moving towards AI. So today, if somebody is asking me, why has Indian markets not performed? One answer that everybody talks about is that India does not have an AI story to play, and hence money is going where the AI story is. True. But there is this another answer that nobody is talking on the internet, because this money also has a lot of option outside. What is that option? Today you can invest in a US government T-bill at 4.6% in US dollars. So you are making a 4.6% US dollar return, right? And if I add a 4% depreciation to that, in rupee terms you are making a US government return of 8.5%. Why will money come to the India markets? That's the same story if you look at Europe. Europe is trying to blow up their balance sheet because they want to raise more money from the market to be able to spend on defense, right? Their fixed income or sovereign debt is also offering a pound return which is significantly higher than what historically you've seen. That's the same case with Japan. So on fixed income option, you have currency denominated options available. They are far superior. On equity, you have the AI story that plays out well. Why will money come to India? And I don't see a reason why 2026 is going to play out any better for the other part of the market. Okay. But of course, what I see from here is that I think rupee depreciation has slightly been overplayed. So there is this REER in very simple language means it's a listed value of what the rupee should be, without going into too much of technicality, right? So if you look at this REER number, rupee is extremely undervalued at this point in time, right? So it looks like that rupee has a lot of catch up to play, and depreciation will slow down for the next 2-3 years.
And you anticipate that that will happen?
I am hoping that will happen, because look, what will happen is that the rupee depreciates 3-4% every year. Now in the last 2 years, you have depreciated 18%. Okay. Now 18% in general is a 4, 5, 6 years of depreciation, which you've done in 2 years. So there is some catch up that will happen over the next 3 years, where mean to average will mean that the depreciation will happen at a much slower pace. One. So rupee, in my opinion, will do a much better job, right? The Iran and the US war cannot continue for a very long period of time, because in October and November you have midterm elections happening in the US. Gas prices have skyrocketed in the US, interest rates is high, mortgage payments are screaming through the roof. So the retail janta there in the US has a problem, and Trump will have to solve this. So maybe Iran is not able to throw a bomb directly to the US, but financially US is also facing a crisis because of this war. So this war will have to at some point in time come to a logical end before the midterm elections happen. Otherwise, Trump has a hard time. Third, over the last 18-20 months, India markets have not done anything great, right? So our valuations have corrected. We've also seen time correction on our equity, and I think that will also play out for India equity. Fourth, I am not very bullish on the AI story going forward from here on at these valuations, right? So suppose if you say, yes, the world markets have gone up, but there is only one thing that has played out, which is the AI story. So if you forego the 2 stocks in Korea, which is a Samsung
and one in Taiwan,
and one in Taiwan, there is nothing else that the markets have done there also, right? And same is the case with China in general, and US is a little different, but the others have only played the AI story and nothing else has worked for them. So if AI does not do well, right, going forward, then there is going to be a big flow of money out of those markets, which will start looking for other markets where they can deploy. Now you might say, why will the AI not do well? I don't know, when will it?
It might do well, but it is most likely overpriced and overvalued.
100%,
right,
because see what has happened in AI, if I can give you a simple context. When the story started playing out well, you saw the LLMs do well, the Magnificent 7 did well, That was the first part of the AI rally. The second part of the AI rally was the data centers and all of that. The third part of the rally is the hardware of the data center. You have the chips, semiconductors doing well, you have the electronics doing well and all of that.
Right.
Right? Now only this part of the rally is doing well. Neither is the data center doing well. And like I explained to you, 7 of the 3 Magnificent 7 has actually lost money in 2026. Now for these guys to do well, the capex story in the data center has to really play out well.
And it's also a long story to play out.
It's a very long story.
Right.
Right? You are investing trillions of dollars. You don't even know when this will end up making monies for you. There is a guesstimate up to 2028, $1 trillion of debt will be raised to be able to build data centers. When are these guys going to make ROC or ROE on the monies that they are investing? Plus interest rates are going up. So if they are going to raise debt, that's going to become even more expensive. So at one point in time, you will reach a situation where the markets will say, boss, okay, hold on. What am I paying for? So like I was saying, all of these 3-4 things may not work out for India in 2026. But I think if you have 2-3 years of investment horizon, India becomes a great story to invest in my opinion. Because I'm assuming that in the next 2-3 years, the AI story will downplay or start downplaying itself. Then where will the global money have to go? They'll have to come back to the fastest growing economy in the world, which is India.
So you think FIIs will also come back?
In my opinion, FIIs should come back. FIIs will come back when AI story will start to downplay. Look, nobody knows when will that happen, but I'm assuming that it cannot continue to run that it runs the way it currently runs.
So there was also a report by Jefferies actually which said that the resilience of Indian investors and continuing to do SIPs and all has actually given an easier exit to FIIs. Any opinion on that?
I don't really subscribe to that thought specifically. Imagine that these FIIs kept exiting and the domestic money was not in place. So there could have been 2 things that had happened. So had FIIs continue, then the fall in the Indian markets would have been significant. If the fall in the Indian market would have been significant, then you are asking yourself 2 stories or 2 questions. Would the fall have led to FIIs not sell, or would the fall have led to FIIs continue to sell? I believe the FIIs would have continued to sell, because if that was the case in 2008 also, they should have stopped selling because nobody was there to buy them out, right? Or 2013 or 2018. I think FII money that is selling is hot money, and the hot money is not looking at anything else. They don't look at what Twitter discussions are happening. They will click the sell button when they want to sell and they see an opportunity elsewhere. So I don't really subscribe to that thought.
I think I want to come to a very interesting segment of this conversation now, which is a form of rapid fire. So this investor that we're talking about, right, this 35-year-old or any investor for that matter, they're always wondering, they will read headlines about, okay, like, RBI has done this and like, global rate hikes have happened, this and that. They don't know how it really impacts their own portfolio. When US Fed hikes rates or cuts rates?
So when the US is going to raise rates, what that typically does is strengthens the dollar and weakens the rupee. Weakening rupee is negative for equities. Strengthening dollar will when interest rates go up, typically more money will go into fixed income, and hence it is negative for gold also, right? So when interest rates typically go up, it is negative for gold, negative for equity, and it is also negative for fixed income, because when interest rates go up, traded bonds in the market falls, because the newer money will chase newer bonds which are paying higher returns. So it's actually a negative situation for almost all asset classes. So India cycle is 18 to 24 months is what India rate cycle is, from the top to bottom of cutting or increasing.
RBI cuts rates or hikes rates?
I think very similar. So if RBI is going to hike rates, it's going to be negative for the markets, because look at it very simply. If any company who is raising money from the markets to run operations or to do capex will find that money to be expensive, If the money is expensive, then their cost goes up. If interest rates go up, loan become expensive, will hurt the demand of consumption. Because if your loan is becoming expensive, your car will become expensive, your house purchase will become expensive. So again, negative for the markets.
Rupee falls sharply.
We are seeing what is happening to rupee falling, right? So again, all negatives. You have fixed income negative, you have gold negative, and you have equity negative.
So the next one is dollar index rises.
So again, dollar index rise is very similar to your first question, that dollar will go up. When dollar goes up, the other currencies weaken. Other currency weakening is bad for India equity in general, and bad for gold also.
Crude oil rises.
Crude oil rising is again negative for India, because when crude oil rises, our import bill becomes expensive, and because we pay dollars for importing crude, our forex reserves go down. That's again negative for asset classes for us.
Now something which is under, like, let's say global risk, war breaks out.
I think it's negative for every asset class except for gold. Typically gold should go up. You might argue why gold is currently not going up when
because it went up too much. Yeah. Okay. But otherwise generally gold
will go up.
Got it. Global liquidity dries up.
Global liquidity dries up is going to be a big problem for global markets then to India, because India, we are already seeing that situation over the last 18-20 months where global liquidity is pulling out of India, but domestic liquidity is great in India. So of course it will affect us, but it will affect much more to the global markets.
In the rest of 2026, or maybe even after that a little bit, what are some things that investors should avoid completely?
I think investors should definitely avoid chasing what is working, because probably, in my opinion, we are at an end of a cycle in all asset classes, and what you've seen happen in the past may not repeat. So you probably may be entering at the peak or at the bottom of a cycle that you don't understand. So don't try and do something that you don't understand, and don't play the story that has played out. This is the time to actually go contra, then go momentum.
So anything that investors should do differently, like of course we've spoken about the general rules of thumb and everything in this podcast. Anything that they should do differently, especially in the coming few months?
No, I think they should stick to their core portfolio and not try and
be boring.
Yeah, be boring, because boring makes money in this market. But if you are, let's say for example, sitting on cash, right? Great time to start deploying over the next 6 months. If given an opportunity and I take you back to 2020 crash, and you see that the markets have fallen 40%, what will you do as an investor?
Invest more.
You will invest more, right? That's the same thesis that we play out on a regular basis whenever something like this reoccurs. Keep asking yourself that if you've seen 2020, right, and if you, given an opportunity, will reinvest at the 2020 lows, there is no reason for you to change your decision at this point in time. Why do you think people who have more experience of investing in the market get scared less? Is because somebody like me who's, let's say, seen 4 cycles.
Hand.
Exactly. Somebody like me has seen 4 cycles. I know what happened in 2008, I know what happened in 13, 18, 20. Now I know that if the next fall has to come and I have 10 years after the fall, I would want to accumulate my money everywhere to invest more money, right? So cycles only give you more confidence.
Because in hindsight, that looks like an opportunity, but the present looks like a crisis.
Absolutely.
But 5 years later, this will look like an opportunity.
Absolutely correct.
So yeah, no, makes sense. Absolutely. Thank you so much, Kirtan. I think this is one of the most knowledge-packed, podcasts that I have been a part of.
Anvi, I can only tell you that the outcome of the conversation is only as good as the questions from the host. So
that's
likewise
very kind.
to you, you've been a great host. You've asked the right questions, and I'm so glad we had the conversation.
Absolutely. Thanks, Kirtan.
Thank you for having me.